Good morning and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. The government is going ahead with its plan to privatize two state-run banks by introducing a bill in Parliament to amend the relevant banking laws. Meanwhile, reports have emerged that the centre may not sell its entire shareholding and hold on to a 26% stake in the banks. What merits does the government see in not letting go of this stake, and will this complicate its efforts to attract strategic investors? Let's understand.
The Centre is tabling a bill in the upcoming winter session of the Parliament, beginning November 29th, to amend two banking laws. Amendments in Banking Companies Acquisition and Transfer of Undertakings Act 1970 and 1980 and the Banking Regulation Act 1949 will pave the way for privatisation of two public sector banks as announced in the Union Budget in February. It is being speculated that Indian Overseas Bank and the Central Bank of India are most likely to go under the hammer. The Centre owns more than 90% in both these banks. Business Standard on Friday reported that the centre may continue to hold at least 26% stake in these banks for now. The quantum of the initial stake sale will be decided while finalising the contours of the transaction. This would mean an about turn in the government's privatisation strategy after its successful sale of Air India to the Tata Group. The national carrier had failed to attract any bidders in 2018 when the government tried to offload 76% stake in it. This prompted the government to offload its entire 100% stake, for which it received buyers. But the case may be different when it comes to banks, argues Business Standard's A.K. Bhattacharya.
When the government reduces its equity stake in a public sector bank to 26%, it achieves quite a few things. Number one is that its majority control over that entity is gone. Number two, parliamentary supervision of those banks is also gone. And number three, the Comptroller and Auditor General of India can no longer audit its accounts. So once the Banking Regulation Act is also amended suitably, one has to see that whether RBI gets the complete power of appointing the board, appointing the chairman, not really appointing the chairman, but approving the appointment of the chairman, and has the regulatory power of superseding the board in case the bank behaves in an imprudent manner. But what is very clear is that if the government reduces its stake to 26%, it is no longer a case of a public sector bank. It will be, for all practical purposes, a private sector bank. The government may not get a proper valuation of the bank if the government retains 26% stake, but it will also probably give some comfort to the investor who buys 74% stake in these banks, that the government is still there as a partner, and in negotiating the difficult political terrain of managing the trade union activities who may be resisting this transfer of ownership, government being there would be actually a matter of comfort.
Earlier, the government had reaped a bonanza by following a similar model with the sale of a 45% stake in Hindustan Zinc to Vedanta in 2002 and 2003, along with the transfer of management control. The 30% stake the government retained is today valued at Rs 42,000 crore. It may be looking to cash in on a similar upside in the privatized banks in the future, as a strategic buyer is expected to bring in improved efficiency. We also spoke to a columnist Tamal Bandyopadhyay on this.
Well, there is a lot of questions about should the government continue to hold 26% while privatizing the two public sector banks. I would like to believe it's logical. We never expected, I think those who have been tracking the financial system never expected government to give up its full control. So from 51% bringing it down to 26% is quite logical. I think more important is this, whether government gives up the other powers. Like now under the Banking Regulation Act as well as Bank Nationalization Act, government holds power, which is appointment and sacking of CEOs to the appointment of boards, etc., etc. So those are more important things. I think this per se 26% holding, yes, it gives the power to the government to block any special resolution. That's under the Companies Act. And once you have privatized the banking, the two banks will become companies. They will be regulated by the Banking Companies Act, like in the case of IDBI that was what happened. Government still holding 26% while privatizing to public sector bank is not a big negative, provided the government is willing to give up its other powers, which it enjoys under the different segments of different acts.
With the 26% holding, the government would have the power to propose or block special resolutions. But if it can give up its other powers that it enjoys under various laws, private buyers will be more than interested to control a bank. So far, it looks like the government is on the right path.
We will know the quantum of the government's stake sale in the two public sector banks and data on these transactions in a few weeks. But the government's relationship with data has always been complicated. When Covid-19 struck India, the only data available was information shared in social media posts by people declaring cases in their vicinity. It wasn't until the announcement of a nationwide lockdown that the central government started publishing regular updates on its website. State governments took even more time to create their own dashboards. Since then, there has been some official flow of data, but that has been uneven across states. Business Standards Ishan Gera assessed COVID-19 data made available by the centre and 35 states and union territories on 11 key criteria. Let's head to Ishan and see what he could uncover.
Data, as you would know, has shaped policy decisions across the world, but India's relationship with data has been complicated. Even so, the COVID-19 pandemic has proved a big step up for many governments, usually reticent about releasing public information. Today, the central and state governments share data on cases, deaths, and tests, but information gaps still exist, and accessibility is still an arduous task. Some good private initiatives that came up early during the pandemic have helped researchers and journalists report on COVID-19 situation in the country. But with some of them, like COVID19India.org, discontinuing their service, dependence on state and central governments for data access has increased. Our analysis found that only 22 of India's 35 states and union territories had made a digital dashboard on COVID-19 information. 5 did not have updated dashboards, and 1, Puducherry, updated it with a lag of 7 days. While almost all states, 32 of the 35 to be precise, posted their daily COVID-19 bulletin on social media, not everybody provided all the information. Only 13 states provided complete information on the kind of COVID-19 tests they had conducted, and most did not categorize RT-PCR and rapid antigen tests separately. The central government has made case positivity, or the number of COVID-19 cases as a proportion of total tests conducted, a parameter to assess severity of COVID-19 in a district. But only 10 states provided data on district tests for COVID-19, which is instrumental in calculating case positivity. On the 11 criteria for easy data access, not even one state got a perfect score. Only 7 of the 35 states and UTs satisfied 10 of the 11 criteria. Only 2 could deliver data on 9, and 12 states met fewer than 7 criteria. the worst performance in data management have been some of the country's largest states by population. Even those that have scored well on our data access index have had myriad issues. Punjab, for instance, did not put its medical bulletin on COVID-19 website for almost a week. Jharkhand, owing to a strike, did not update the dashboard. Data for Bihar is available only in Hindi. Andhra Pradesh, which satisfies 7 of the 11 listed criteria, has been releasing its medical bulletin in Telugu. Another interesting aspect is states that are reluctant to publish data are also the ones which are testing less. For example, Uttar Pradesh, which satisfies only 2 of the 11 criteria, Bihar, which satisfies 5, and Madhya Pradesh, which satisfies 4, have the lowest testing ratios in the country. Are only states to blame for this difficulty in data access? The central government hasn't been helpful either. It does provide data on cases, deaths and recoveries, but despite getting information from states, it does not give data on state-wise or district-wise tests. Besides, the website of Ministry of Health and Family Welfare does not let users access historical data on COVID-19 in the country. Clearly, governments still need to do a lot more to be transparent and forthcoming with data.
As Ishan pointed out, India certainly has some course correction to do, and the pandemic certainly presents an opportunity to do so. Talking of the pandemic, benchmark stock indices saw a major slide on Friday on reports of a new vaccine-resistant COVID variant. Now, they seem poised to log their first monthly loss in 8 months in the current month. Will the market correction continue in December too, or will the indices bounce back? Let's find out what to expect. The markets tanked heavily in trades last week, with key benchmark indices, the Sensex and the Nifty, logging losses of over 3.5% each. In the process, with just 2 trading sessions remaining, the benchmark indices seem poised to log their first monthly loss in 8 months this November. The markets were already on a weak footing following persistent FII selling, high crude oil prices, and fears of a possible change in interest rate scenario. They suffered another severe jolt on Friday as reports of a new heavily mutated COVID-19 variant originating from the African nation Botswana came in. Here's how Gaurang Shah, Senior Vice President, Geojit Financial Services, sees markets play out going forward.
See, Puneet, honestly, because of this, news flow, which is not going to die down anytime sooner, or, concerns will definitely be there whenever these kind of new variants, appear in whichever country. But markets will always react accordingly, and markets have a tendency of overdoing things on a lot of parameters. But these are the levels where we've been earlier also in September, first, second week, 17,300, 200, 17,000, 17,300 are the levels where we've been there a couple of times. So if you're a trader, short term, medium term kind of, trader, you need to worry. But long term, I don't think there are reasons to worry. I think these are great times to buy good quality stock companies and hold in your portfolio from a long term period of time.
Looking ahead for December, the markets will have a slew of news flow to digest, starting with the planned $15 billion per month reduction in the bond buying program by the US Central Bank. Traders and investors may also look to take home some profits owing to the calendar year end. Echoing similar views, Avdut Bakkar of Business Standard says that the current scenario demands investors be cautious.
The key support for BSE Sensex comes at 57,000 and for Nifty it is at 70,000 levels. And as long as these support marks are defended on closing basis, one can expect a smart recovery towards 59,000 and 17,600 level from a very short-term perspective.
While crude oil prices are going to be volatile in the near term and severity of the new COVID variant is yet to be determined, the market seems to have taken its precaution. Let's wait and watch how it plays out over the next few days. While the market remains sensitive to the panic triggered by the new COVID variant and other factors, Karnataka has sounded an alert in its districts bordering Kerala, where at least 13 cases of Norovirus surfaced 2 weeks ago. Kerala's health department, which was already facing a tough time controlling the COVID-19 outbreak, has taken all the measures to ensure that Norovirus does not spread. This report explains what the Norovirus infection is and how serious it is.
At least 13 students of a veterinary college in Kerala's Wayanad district were found infected with Norovirus 2 weeks ago. It is a highly contagious virus that causes severe vomiting and diarrhea and infects people of all ages. It can spread very easily through food or water that is contaminated and also through close contact with an infected person. Just like COVID-19, infected people may show no signs or symptoms, but they are still contagious and can spread the virus to others. A person can get norovirus infection many times because there are several variants and an infection with one type may not protect them against the other type. The chances of getting the infection are high in closed and crowded environments such as in public transport, hospitals and in schools. And the most common symptoms of the norovirus are nausea, vomiting, diarrhea and stomach pain or cramps. Other symptoms include fever, headache, body ache and muscle pain. The virus causes inflammation of the stomach or intestines, which is called acute gastroenteritis. The most important thing is to take rest and ensure constant intake of fluids to avoid dehydration. The symptoms usually begin 12 to 48 hours after exposure to the virus, and most people get better within 1 to 3 days without treatment. There is no specific medicine to treat people with norovirus illness. It can take up to 2 weeks after recovery for the body to shed the virus completely, and longer if there is an underlying health condition. Maintaining hygiene is the key to prevent norovirus from spreading. Doctors suggest washing hands thoroughly with soap and water, especially after using the toilet and before and after handling food. Other prevention tips include washing fruits and vegetables before eating, cooking seafood thoroughly, and disinfecting surfaces that might have been contaminated.
That's all we have for you today. We will be back tomorrow with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.